Investing your money is crucial for building wealth. It's not just about saving, it's about growing your financial resources over time. By putting your money into various investment vehicles, you can potentially earn returns that outpace inflation and help you achieve your financial goals. It's about making your money work for you, not just sitting idle. When you invest, you are essentially putting your money to work, allowing it to grow and multiply. This can be through interest, dividends, or capital gains. Two popular investment options are mutual funds and exchange-traded funds, or ETFs. These are collective investment schemes that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Both offer ways to diversify your portfolio, spreading your risk across different assets. Diversification is a key strategy in investing, as it helps to mitigate risk by not putting all your eggs in one basket. Mutual funds and ETFs are like baskets holding a variety of stocks or bonds. This means that when you invest in them, you are not relying on the performance of a single asset, but rather a collection of assets. When you invest in one, you own a tiny piece of everything inside. This fractional ownership allows you to benefit from the performance of multiple assets without needing to buy each one individually. Imagine it like a fruit basket. You get a taste of apples, oranges, and bananas all at once. This analogy helps to illustrate the concept of diversification in a simple and relatable way. These investment vehicles have become increasingly popular, especially among those new to investing. They offer a convenient and accessible way to start building a diversified portfolio without needing extensive knowledge or experience in the financial markets. They offer a simple way to access a diversified portfolio without needing to buy individual stocks or bonds. This simplicity and ease of use make them an attractive option for many investors. But how do you choose between a mutual fund and an ETF? Each has its own set of advantages and disadvantages, and the right choice depends on your individual financial goals, risk tolerance, and investment strategy. Let's break down each option and explore their unique characteristics to help you make the right decision for your financial goals. By understanding the differences, you can choose the investment vehicle that best aligns with your needs and preferences. Let's start with mutual funds. Mutual funds are one of the most popular investment vehicles available today, and for good reason. A mutual fund pools money from many investors, creating a large sum that can be invested in a variety of assets. This pooled money is then invested in a diversified portfolio of assets, which can include stocks, bonds, and other securities. Think of it like a team effort, where everyone contributes to a shared goal. Each investor owns shares of the mutual fund, representing a portion of its holdings. A professional fund manager, the team captain, makes all the decisions about which securities to buy and sell. They are responsible for managing the fund's portfolio and ensuring it aligns with the investment objectives. They use their expertise to try and achieve the fund's investment objectives, which could be anything from steady growth to high returns. The fund manager's decisions are based on extensive research and analysis. When you invest in a mutual fund, you buy shares of the fund, not the individual securities within it. This means you gain exposure to a wide range of investments with a single purchase. The value of your shares goes up or down depending on the performance of the assets held by the fund. If the fund's investments perform well, the value of your shares increases, and vice versa. Mutual funds are purchased through brokerage firms, directly from the fund company, or through financial advisors. This flexibility makes it easy for investors to get started. They offer a convenient way to access a professionally managed portfolio without needing to pick individual stocks or bonds yourself. This can be particularly beneficial for those who lack the time or expertise to manage their own investments. Not all mutual funds are created equal. One key difference lies in their management style, active or passive. Active management is like having a personal chef who handpicks every ingredient for your meal. The fund manager actively buys and sells securities with the goal of outperforming a specific benchmark, like the S&P 500. They research companies, analyze market trends, and make strategic decisions to try and maximize returns. Passive management, on the other hand, is like following a recipe. Passive funds track a specific market index such as the S&P 500 by holding the same securities in the same proportions. The goal is not to beat the market, but to match its performance. Passive funds typically have lower fees than actively managed funds because they require less research and trading. Exchange-traded funds, or ETFs, are similar to mutual funds in that they offer a way to invest in a diversified portfolio of assets. However, there are some key differences. Like mutual funds, ETFs hold a basket of securities, such as stocks, bonds, or commodities. However, unlike mutual funds, which are bought and sold through fund companies, ETFs are traded on stock exchanges just like individual stocks. This means you can buy and sell ETFs throughout the trading day, giving you more flexibility than mutual funds, which are typically priced only once at the end of each trading day. ETFs also tend to have lower expense ratios compared to mutual funds, making them a more cost-effective investment option. Section 5, Costs Matter, comparing fees and expenses. When it comes to investing, every dollar counts. Both mutual funds and ETFs charge fees for managing your money. These fees can eat into your returns over time, so it's important to understand the different types of costs involved. Mutual funds typically charge an expense ratio which covers the fund's operating expenses, including management fees, administrative costs, and marketing expenses. ETFs also have expense ratios, but they are generally lower than those of mutual funds. This is because ETFs are passively managed and require less trading. In addition to expense ratios, some mutual funds may also charge loads, which are essentially sales charges. Loads can be front-end, meaning you pay them when you buy the fund, or back-end, meaning you pay them when you sell. Despite the potential for higher fees, mutual funds offer several advantages for investors. One of the biggest benefits is diversification. By pooling money from many investors, mutual funds can invest in a wider range of securities than most individual investors could afford on their own. This diversification can help reduce risk by spreading your investments across different asset classes, industries, and geographies. Another advantage of mutual funds is professional management. When you invest in a mutual fund, you are essentially hiring a team of experts to manage your money. These professionals have the experience, resources, and expertise to research companies, analyze market trends, and make investment decisions on your behalf. ETFs have gained immense popularity in recent years, and for good reason. They offer a range of benefits that make them an attractive option for both novice and experienced investors alike. One of their key advantages is their tax efficiency. Unlike mutual funds, which can trigger capital gains taxes even if you haven't sold any shares, ETFs are designed to minimize these taxable events. Because ETFs are structured differently than mutual funds, they tend to generate fewer taxable events, such as capital gains distributions. This is due to the unique in-kind creation and redemption process that ETFs use, which helps to keep the tax burden lower for investors. This can be a significant advantage for investors, especially those in higher tax brackets. By reducing the amount of taxable income, investors can keep more of their returns, which can compound over time to create substantial savings. Another benefit of ETFs is their affordability. They typically have lower expense ratios compared to mutual funds, which means you pay less in fees. As mentioned earlier, ETFs typically have lower expense ratios than mutual funds. This is largely because they are passively managed, tracking an index rather than trying to outperform it. This is because they are passively managed and require less trading. Less trading means fewer transaction costs, which translates to lower fees for investors. Lower fees mean more of your money is working for you, which can lead to higher returns over time. The savings on fees can be reinvested, further boosting your investment growth. Additionally, ETFs offer a lower barrier to entry for investors with limited capital. You don't need a large sum of money to start investing in ETFs, making them accessible to a broader range of people. Because ETFs are traded on stock exchanges, you can buy and sell them just like individual stocks. This provides flexibility and liquidity, allowing you to react quickly to market changes. This means you can start investing in ETFs with a relatively small amount of money. Whether you're looking to build a diversified portfolio or simply want a cost-effective way to invest, ETFs offer a compelling option. While mutual funds offer several benefits, it's essential to be aware of their drawbacks as well. One of the most significant drawbacks is the potential for higher fees. As we discussed earlier, high fees can eat into your returns over time, so it's crucial to choose funds with reasonable expense ratios. Another potential drawback of mutual funds is the risk of underperformance. While professional management can be an advantage, there is no guarantee that a fund manager will outperform the market. In fact, many actively managed funds fail to beat their benchmarks, especially over the long term. Additionally, mutual funds lack the intraday trading flexibility of ETFs. Since they are priced only once at the end of each trading day, you can't buy or sell mutual funds during market hours. While ETFs offer numerous advantages, it's essential to consider their potential drawbacks as well. One key consideration is market risk. Like individual stocks, ETF prices can fluctuate throughout the trading day. This means you could lose money if you buy an ETF and its price goes down. Another factor to consider is trading costs. While ETFs generally have lower expense ratios than mutual funds, you will typically have to pay a commission each time you buy or sell an ETF. These commissions can add up, especially if you trade frequently. Ultimately, the best investment choice for you will depend on your individual circumstances, financial goals, and risk tolerance. For more insights on mutual funds, ETFs, and other investment topics, make sure to subscribe to our channel and hit the notification bell.